Buenos días a todos. Aunque la mayoría de vosotros ya me conocéis, mi nombre es Ana Álvarez y formo parte del equipo de Franklin Templeton desde hace más de 10 años ya. Lo primero que queríamos era agradeceros a todos que hayáis venido hoy a compartir este Investment Day con nosotros. Sabemos que hoy es un jueves, casi viernes, que tenemos por delante todos un puente y tal y como están los mercados y como tenéis vuestras agendas, os agradecemos doblemente que hayáis venido a compartir el evento de hoy con nosotros. Yo estoy convencida de que con la calidad de los ponentes que vamos a tener hoy, os va a haber merecido la pena el haber dedicado este tiempo a estar hoy aquí. Aunque la mayoría de los que estáis aquí estáis familiarizados ya con la casa, creo que es importante recordar que Franklin Templeton es una casa que lleva dedicándose a la gestión de activos desde hace más de 70 años. Es una de las gestoras independientes con mayor presencia internacional y a día de hoy gestionamos un patrimonio de casi 800.000 millones de dólares en todo el mundo. Y concretamente en España este año, y muchos de vosotros nos acompañasteis durante el mes de mayo a la fiesta que organizamos, hemos cumplido 20 años desde que abrimos la oficina aquí en España. Yo creo que eso demuestra claramente el compromiso que Franklin Templeton tiene con el mercado español. Y bueno, a pesar de los mercados tan complicados que nos está tocando vivir en este 2018, como oficina, este año hemos sido capaces de crecer casi un 20%. Y bueno, yo creo que es en gran parte gracias a la confianza de todos vosotros, los que estáis hoy aquí. Y bueno, queríamos no dejar de daros las gracias por todo ese apoyo que llevamos recibiendo todos estos años desde que estamos aquí acompañándonos en este mercado. Y nada, sin más, todos al entrar os han dado una bolsita con la agenda, con la dinámica que vamos a seguir hoy. Para empezar, tendremos un panel macro donde vamos a analizar cuál es la situación económica actual y cuáles son, desde nuestro punto de vista, las principales oportunidades y riesgos que presenta el mercado para este 2018. Después continuaremos con una ponencia de Brooke Ritchie, que es nuestro gestor del Franklin K2 Alternative Strategies. Franklin Templeton gestiona a día de hoy más de 40.000 millones de dólares en activos alternativos, lo que representa una de las principales apuestas que está haciendo la casa por seguir creciendo en ofreceros a vosotros pues nuevas alternativas de inversión que complementen la oferta de soluciones tradicionales que veníamos ofreciendo hasta el día de hoy. Después de Brooke Ritchie y tras el coffee break, el mago Moore nos hablará sobre el poder positivo del cambio, ¿no? Que yo creo que en este momento y con la situación que estamos viendo en los mercados os va a servir de gran ayuda en vuestro trabajo del día a día. Y ya por finalizar tendremos a Grant Bowers, que es el gestor del Franklin US Opportunities, especialista de renta variable americana dentro de la casa. Y bueno, yo creo que aquí Grant tratará de contestaros a la pregunta que yo creo que más frecuentemente sale con todos vosotros en las reuniones, ¿no? Y es, ¿sigue teniendo recorrido la bolsa americana? ¿En qué punto de ciclo nos encontramos? ¿Va a seguir la tecnología siendo uno de los catalizadores del crecimiento en esta fase ya más madura de ciclo? Espero que Grant sea capaz de arrojarnos un poco de luz y dejaros a todos pues, las ideas más claras en todo este tema que tanto nos preocupa a todos. Y luego, por último, y ya para finalizar, sobre la 1 tendremos un cóctel en la planta de arriba, será un almuerzo, espero que podáis quedaros la mayoría de vosotros. Y por favor, no os olvidéis, habéis visto a la entrada que hay unas azafatas para todos aquellos que tengáis la certificación EFPA y queráis que el evento os cuente para certificaros las horas. A la salida, no os olvidéis de dejarles los datos para que así compute vuestra asistencia. Yo creo que, sin más dilación, como lo más importante y para lo que habéis venido todos es para escuchar a estos magníficos ponentes que tenemos hoy aquí. Como primer panel contaremos con Javier Villegas, que es director general de Franklin Templeton para Iberia, y tres fantásticos ponentes, Sonal Desai, que ha sido durante muchos años miembro del Fondo Monetario Internacional y que a día de hoy es nuestra corresponsable de renta fija global de Franklin Templeton y gestora de cogestora de 3 de los fondos más representativos de nuestra casa: Templeton Global Bond, Templeton Global Total Return y Templeton Emerging Markets Bond, que muchos de vosotros ya conocéis. También contamos con David Zahn. David Zahn es nuestro responsable máximo de renta fija europea y gestor de muchos fondos de la gama, entre ellos el Franklin European Total Return. Y por último, no menos importante, contamos con Basel Catón, que es miembro de nuestro comité de inversiones de renta variable emergente y gestor de varios de los fondos del Templeton Emerging Markets Group. Muchísimas gracias a todos por venir y sin más dilación os dejo paso con Javier Villegas. Gracias.
Muchas gracias. Muchas gracias, Ana. Muchas gracias a todos vosotros por estar aquí. La verdad es que a mí me ha hecho mucha ilusión volver a ver a tantos amigos del sector tras mi vuelta de Estados Unidos y también ver caras nuevas que espero poder conoceros durante el día de hoy. Como decía Ana, son momentos complicados. Gracias por estar aquí. Los clientes estarán llamando, estarán preocupados, pero bueno, creo que este es el momento en el que el asesoramiento y vuestro trabajo toma más valor y esperamos ayudaros con la conferencia de hoy, ¿no? Nuestro objetivo básicamente es tratar de compartir con vosotros cuáles son nuestras principales ideas de inversión para que las reflexionéis, las maduréis, las compartáis con vuestros clientes y esperamos os ayuden a reorganizar las carteras de cara no solo al 2019, sino también en el medio y largo plazo. Paso al inglés y así empezamos con el panel. So, David, Sonal, Basil, thank you very much for being with us today. It's a real privilege for me, being honored to moderate this panel with 3 of the most successful investment professionals in the investment industry. So, we've called this panel the moment of truth. I think this is what we are living today. We came from a great expansion of the market since 2009. Equities were performing. Fixed income were performing, but now we arrive into 2018. Volatility has came back to the markets. Interest rates in the US are going up. There are some inflation fears, trade tensions. So I think this is the good time for active management to stand out. Before I go into markets, I would like to ask you a personal question because I think this is a people business. So I want all our friends to get to know a little bit more about yourselves and know how do you react in difficult times. So David, if you can share with us any moment of truth during your successful career and how did you overcome that time?
It's a tough one. There's been many, so which is the best one to talk about? I think that for me, I think one that sticks out was in 2008, and it was kind of in the summer of 2008 before we had all the problems. And I remember we were having one of our weekly meetings, and we discussed, are we set up for a big event, a multi-standard deviation event? And almost everybody in the room said, no, of course not, but we're not expecting that. And I was like, oh. Yeah, so I think that for me it's when you see sentiment go wildly one way or the other, that's when I think you can see opportunity, and I feel like we're maybe getting to a similar point where everybody seems to think everything is fine, and I agree everything is fine. I don't see what the problem will be coming forward, but I do think volatility is going to increase, and I think that's one thing not everybody agrees on, and to me that is the opportunity. We've had 10 years of central banks basically repressing volatility, and volatility will pick up, which means markets will get more volatile, which means that active managers, we can actually make money easier than we have in the last probably 3 or 4 years.
Yeah. So you fear when consensus,
yes,
it's really everyone into the same thought.
Yeah.
So now, anything in your career during your IMF times or in the global macro team?
Actually, there are so many. Much like David, it's hard to choose one. But if I want to think about one which probably defined a lot of the subsequent choices I made, it would be the choice to leave the IMF. I left the IMF to follow my husband to the UK, where he was working for the private sector. And I didn't have a job, so it was a question of did I want to take the risk of just jumping and doing this before I knew what was going to be there on the other side. And since then, I think that idea that, you can just jump, sometimes you have to take risk to get returns. So I think going back to that active management theme, you have to take risk. When all of you pay us, it is to take risk. And I think taking that risk, but trying to understand fully why you're taking it and what the potential is for reward, that's priceless. So
it's very interesting that in my times in the US, people, let's say, were willing to take more risk. Maybe here in Europe we're a little bit more conservative risk, but at the end of the day, no pain, no gain.
I think that's essentially it. So you go through periods of uncertainty, but at the end of that period of uncertainty, you have to decide, did you make the right decision or did you not?
Right. Basil, what about you, investing in emerging markets? Any difficult times?
Plenty of difficult times. No, I think for me, everyone has their 2008 moment, but my 2008 was really, having left London and gone to Dubai and joined some people to set up an independent asset management company there. We had seen, quite fortunately, some early success with that. The business grew. We had 40 employees, and then 2008 came. And for me, just dealing with the consequences of managing people thereafter, managing our clients, and seeing really what was a year and a half of success just evaporate was a tough lesson in terms of risk management, but also a lesson in terms of things don't come quickly, and you have to rebuild things from scratch, which subsequently we did, and joined Franklin Templeton as an acquisition.
Mm-hmm. Thank you very much. I think that's a real tough one. Dealing that 2008 with people, with clients, it's a tough one. So okay, let's start with markets. So David, the moment of truth for European fixed income. European fixed income, obviously for us in Spain, is a core asset class. However, we live in a low interest rate environment. So how are you managing portfolios in order to get positive returns in this difficult environment?
Well, first I would say that if you're expecting that we will not be in a low interest rate environment in the near future, that's probably incorrect. That in Europe, interest rates will remain low for quite some time. Our own view is that the ECB probably won't hike rates before 2020, 2021, so there's no immediate relief to low interest rates. And so I think that means you have to be quite tactical in how you position your portfolio, and when you see anomalies in the market where something sells off too much or something rallies too much, you need to take advantage of those. And excuse me, I think that's how we're going to add value over the next 12 to 18 months, which is our time horizon, is by looking for opportunities as they present themselves, either through the volatility in the market that we're expecting or from individual countries such as Italy. When Italy maybe has some problems, it will affect Italy, of course, and that may be an opportunity, but it normally spreads to other areas that actually the fundamentals are very good still. And so I think that will present opportunities, and then we can generate very low positive returns.
Right. So we need to know that we are living in a low return environment, but being tactical, you can be able to generate some alpha. So now the moment of truth, and your fund is one of the few in positive territory this year. Where are you finding opportunities? What are you doing?
So I would say that in an environment like this, if you're working with fixed income, there is a massive, first of all, of course, being active, absolutely, but beyond that, for us, being unconstrained by indices helps a lot. We're short US Treasury duration, massively short. So across our funds, if I look at global bond, global total return, we have negative duration, minus 1.3 years on average. We are actively short the euro for some of the reasons David mentioned, that yes, interest rates are low and are likely to remain low in Europe, but are rising and are likely to continue to rise in the US, so we're short the euro. We're short the Japanese yen as well. And then above and beyond that, we are getting a lot of opportunity by being selectively long certain emerging markets. So despite the fact that we expect US Treasuries to go up a lot, up to 4.5% even, I think there are specific specific emerging markets which even in this environment will do quite well, and thus we are able to produce a positive return, taking advantage, if you will, of the differences and the divergences in central bank policies around the world.
Right. So again, being active, selective into some emerging market countries. Hard currency, local currency?
Oh, I should have mentioned, definitely. Not so much hard currency, very much local currency. Even in our total return funds, where we have the option of going into spread markets, we have chosen to actually deploy our capital a lot towards local currency EM, because in terms of relative opportunity, we see more there than in traditional high yield markets, where I think the underlying overvaluation of treasuries and the move up of treasuries will ultimately be reflected in higher yields there.
So local currencies also short in the US treasuries,
yes,
and active and with some short positions in some currencies. Thank you very much. Basil, moment of truth for emerging markets. Obviously, one of the worst performances in 2018. However, when you ask institutional investors, it's one of their favorite asset classes for the next decade, expecting 8 to 10% annual returns. What are your views? What are the opportunities that you're seeing in those markets?
No, you're right. It's been a very challenging year, and there's various uncertainties that the market is very focused on. We think that the market has mispriced those uncertainties, that there's really a fundamentally sound buying opportunity. But I agree with Sonal's point that it's not a one-size-fits-all approach. I think we're starting to see divergence in the market. We're starting to see stronger economies being rewarded. We're starting to see some of the weaker economies show their vulnerabilities. And you've seen some of the currency blow-ups in some of the countries. You've seen some of the other countries which have already made those adjustments go on much sounder footing. So for us, it's a cheap market overall. Mm-hmm. It's trading at a 40% discount to the US, which is a decade low. And the fundamentals are still quite sound. So we see free cash flow at record levels, and most of those companies returning that cash back to shareholders, which is a nice change. From a specific kind of country perspective, I think the key markets that we like are Russia, where we've been overweight because of valuation. We like Brazil on political change. India is increasingly becoming interesting to us. And on the smaller markets, I think Egypt is the one that stands out. Mm-hmm.
Mm-hmm. Yeah, so I think that what you have described it's on our DNA in Franklin Templeton. So a cheap market, 40% discount, and then you're finding opportunities with good fundamentals, and in the long term, those will rise. So very interesting times for us in emerging markets. Let's dig a little bit more. David, you mentioned Italy as one of the opportunities. There are a lot of fixed income managers that sit in the camp that they think it's a good opportunity. There are some others that they think it's a big risk. What are your views on Italy, and how do you think that may impact the development of Italy into the Eurozone?
Well, I think Italy has kind of unwrapped many different things about the Eurozone. One is, I would say that the Eurozone needs reform. We need to see change. I think Italy is the latest country to basically say we need that. Brexit, I believe, is one of the first major ones, but we've seen it in Poland, we've seen it in Hungary, we've seen it now in Italy. They want to have more spending. I think they will come to some type of agreement, but it could get quite volatile before it gets there. And that's purely because I don't think Italy is going to leave the euro. Many people have talked about that's a possibility. The euro project doesn't work without Italy, and I don't think Italy actually would want to leave and actually endure all the pain that would come with that, because many people say, oh, it would be over quite quickly. No, it won't. Take a very long time to recover from that. And so what I think is going to happen is you're going to see volatility in the spreads, and I think that you will look to take advantage of that. But also, it will impact if we start to see it more as a systemic problem for the Eurozone. it will start to hit a lot of other countries. You will see Spanish government bonds sell off. You'll see French government bonds sell off. And so far, Italy has been quite concentrated on Italy. So it's a unique Italian event happening at the moment. But if that starts to spread, then there will be loads of opportunities into credit, into other areas. And so I think, but we don't think that Italy is going to leave and all of a sudden blow up the Eurozone. And on the other side, I would say, if Italy does leave and if it was to leave and blow up the Eurozone, financial markets globally are going to have a massive problem. Italy is systemic to the global world. You will have 2.3 trillion in debt that all of a sudden will go to probably high yield and have much higher yields, and that will become quite a problem. So I think that it's in everybody's interest that Italy remains in the euro. The people in Brussels understand that. People in Berlin understand that, so I think they will come to an agreement.
Okay, so base case scenario, Italy won't leave the Eurozone.
Correct.
That we're going to live through a volatile period, and you're going to take some opportunities to
Correct.
maybe buy some credit or Italy during the year. Thank you very much. Sonal, at the end of last year, beginning of this year, you were one of the few saying that U.S. Treasuries were going to go up to 3%. You were right there. So I wanted to ask you, what's your outlook for 2019, and if you think we're close to the end of the cycle, which is one of the big question marks that we have.
So, when I said that we could break 3% this year, it was more not a forecast for 3%, but it was the fact that nobody thought. When I said this, US Treasuries were at 2.2%, and people thought they would go up 20 basis points. And I think my key point was not so much a target for the Treasuries, but pointing out the undervaluation of Treasuries, the overvaluation of Treasuries was so extreme that we could easily see yields break 3. They have broken 3, and it's with that spirit that I would say that if I were to imagine where fair value for Treasuries is by the end of this cycle, I think we could break 4, get to 4.5 even, without too much difficulty. And that brings you to the issue that you said, which is what is end of cycle. I think we're probably a couple of years away from that, and I'm not seeing the end of cycle as being driven by central bank action. I see this as a more normal, if we are lucky in financial markets. This isn't a 2007-8 style end of cycle. It is an end of cycle which comes because the economy in the US overheats. So you have unemployment moving to unsustainably low levels. Frankly, it's already there at 3.7, but the pace at which we are going, we're likely to approach 3 as we go towards the end of next year. If you get to unemployment of 3, you will see a pickup in wage pressures. You will see inflation pick up. And the Fed is going to continue to raise rates, and it is not going to be a catastrophe for global markets. I think people need to look back to pre-2007. We have lived with higher short rates in the US. Emerging markets have survived, the Eurozone has survived, the US has survived. But as firms invest, overinvest, you start getting excesses being created, you come to the end of the cycle, because then firms start pulling back, firing people. Sorry, that was probably a very long answer, but a long way to say that we could get up to 4.5 on the 10-year, and at the short end, currently markets, the Fed is telling us they'll raise 4 times next year. Market is saying, when they first said that, the market said, nah, once. Now, with the type of results we're getting from the economy, the markets are saying maybe twice. Now, this is where the true divergence, I think, between us and markets comes. I definitely think they're going 4 times, and to me, the risk is that they go 5. Not that they go fewer times, but they go more times. As a central bank, that's the sensible thing for them to do, and it won't be catastrophic.
Right. So you continue to see some fears of inflation in the US.
Yes.
You think the Fed will raise rates 4 times, or maybe
even more.
5
if they
times?
can, I think they're going to go more times. And by the way, I just want to put in a quick note. What I'm saying does not change. I was saying that before the midterm elections. I'll say it now. I don't think the elections are going to influence Fed policy in this way.
Thank you very much. Basil, one of the countries you mentioned when you were talking about opportunities in emerging market was India, which is one of the ones that haven't performed well this year, and many people have concerns around how is India going to perform with oil prices at the level that they are today. So what are your thoughts? Where are you finding opportunities in that big market?
Yeah, so India's had a tough time, and I think it's partly driven by oil prices, which have widened the current account deficit, weakening the rupee in spite of the central bank's intervention. But also, I think, in India we've had a couple of other one-off interventions, including the goods and services tax. We've had the capital gains tax that's been introduced to foreigners. So a number of other areas that have pressured the market outside of the oil prices. Now, I think looking forward, we see that the rupee's adjusted quite significantly. It's down 12% this year. Where we're finding opportunities on this rebound now as the government starts to spend more in the economy is principally in the banking sector. We still see some consumer softness coming through, especially in the autos sector and in the cement sector. What we like is the banking sector, where I think the private banks are actually eating a lot of the market share from the state-owned banks that have had their own liquidity issues. When you step back from all this, you have to remember that India is a population in which 5% of people's wealth is in the financial services. So there's a huge penetration story playing out there, as well as a market share gain story. So we like the market leaders there. We think they're able to grow market share and drive up ROEs, and that's somewhere where we've been adding to. The second area that we like is the export sector, which is principally in the technology export and in the outsourcing. Obviously, with a weaker rupee, it makes them more competitive, and we've seen those businesses do pretty well in this environment. So I think it's going to be a market in which you have to choose the right sectors, but we're certainly starting to see those opportunities come through.
Right. So the India long-term investment story hasn't changed. Market has priced the oil prices today, and obviously has impacted some sectors, but you also see some opportunities in the export sector, banking sector, that you think may benefit, and valuations there may look reasonable. So David, now let's turn into volatility risk, because this is something that I think in the audience people are concerned. So if we continue seeing volatility in 2019, which are the ways that you think of hedging your portfolios, especially those ones that you can be more active in?
Yeah, so in our European Total Return Fund, we can be quite, we can diverge from the benchmark significantly. If you look at it, we're nothing like the benchmark. We actually can also use derivatives to help reduce volatility, absolute volatility. So one of the ways that we're doing that at the moment is by using 10-year French government futures and 10-year German government futures to reduce interest rate risk. So while the nominal benchmark has a 7-year duration, we're running about 3.5 years of duration, and that's helping to reduce the absolute volatility of the fund. And I also think it's, as I said before, of looking at opportunities where we think valuations have gotten too full and exit those before the volatility picks up. And then also looking at, when you see events such as Italy, where you can take advantage of the volatility and kind of go against the grain. And if you look back at our history of running it, that's exactly what we've always done. We tend to be slightly contrarian. And at the moment, we have almost no high yield, whereas many people have high yield in their portfolios to get the added yield. And it's not because we think there's a fundamental problem with high yield and defaults are going to pick up. We just think the valuations aren't attractive. In investment grade, again, with the ECB tapering, we have cut back our investment grade exposure. So we're probably the most defensive that we've been in probably the last 8 or 9 years at the moment, waiting. And we probably were a bit early. We did it in last year as opposed to this year. But basically waiting for volatility to start to increase and to be able to take advantage of it. And so it's using these different instruments and also looking for diversifiers within the portfolio, such as we have Danish mortgages and we have some Polish governments. So it's not just in the Eurozone, it's within Europe itself. And I think having those diversifiers allows you to have the counterbalance to make the overall portfolio seem much smoother, which is what we want to give to our end customers.
So on the European Total Return Fund, that flexibility of being able to move, plus the derivatives and some other tools that you have, and now you are positioned, as you said, a little bit more defensive, waiting for some volatility to come and then take advantage of that.
Correct.
Is that correct? Yeah, perfect. So now you said that your way of management is unconstrained. How are you hedging your portfolio? And I think we've seen the Global Bond and Total Return Fund reduce the volatility quite a bit during the last year. So how are you managing that?
So, I would say this, that actually, as I already mentioned, we are hedging out our long EM positions with what we see as the three biggest risks which we see within markets. So, the rising US rate story. We do have this long EM exposure, very select duration positioning there. So not three risks, but three hedges. So we're using the short euro and the short yen to hedge out the EM currency exposure. Meanwhile, the rates short hedges the overall macro risk within the portfolio. Now, the issue of volatility, I would approach it in a slightly different way, in the sense that we think about immunizing our portfolio from what I consider capital at risk. As interest rates sell off, I think, to put things in an extreme form, if you were one of the portfolio managers who wasn't long enough, and then post-Brexit in 2016, when treasuries hit 140, suddenly decided, oh my goodness, I have to go long. It was a terrible place to go long, but you decided to go long when treasuries hit 140. I just mean that the loss you made from 140 to around 250, 275, I see that as a pretty permanent loss, because I don't know when treasuries are ever going to go back to 140 again. I say this to distinguish it from what I think about as market risk, and currency risk to me is very market driven, and so you will get short spikes in volatility. While the volatility of our portfolios has gone down, we do have a lot of currency exposure within that, and occasionally we might see volatility go up a bit. But I want to point out that being as fearful of periods of jumps and volatility is probably the wrong thing. The last 10 years have been a very unusual period. As we move out from this period, I would instead emphasize that periods of volatility are close to inevitable, and the more important thing to do is to figure out, are you taking advantage of those periods of volatility? Are you actually putting capital at risk? Are you setting yourself up for greater gains as the volatility dies down? We prefer to actually do the latter, to ignore the spikes which just come from market-driven sentiment. I know that this isn't possible in every portfolio, but I would urge you in terms of panic to consider that. Right. The market can sell off briefly, but it can come back very quickly.
No, I think that's very interesting. Volatility, we need to live with it. Yes. It's whether if you take advantage or not. And basically, I think what you said, the way of hedging your portfolio is being very selective on the markets that you're investing in. Hedging with euro and yen is those positions, and also the big risk in the market, which is that the rise of interest rates. You are playing low duration, and even with some short U.S. Treasuries swaps in your portfolio. Perfect. In emerging markets, volatility is something that you need to live with. Yeah. But which is the way that you protect your portfolios in difficult environments?
So as you're aware, our process is a very bottom-up driven investment process. And in that, we generally go for companies that have much higher degree of conviction in the long-term sustainability of their earnings versus companies that are more cyclical and more exposed to factors that are really beyond our control. So how that translates in the portfolio is we'll typically and are currently overweight sectors like technology, consumer staples, consumer discretionary, communication services. Those will typically be overweight, and we generally are able to forecast with more conviction the earnings of those companies. Where you'll find our underweights are typically areas like real estate, materials, energy, where being able to forecast the commodity price is much more difficult, or their sensitivity to interest rates in the case of real estate is much more difficult. So that naturally has led to the portfolio having a lower volatility than the index across multiple time periods, despite having higher concentration levels. I'd say the other embedded sort of volatility protection that we have is we have about 20% of the portfolio typically in companies that are under $5 billion, and that's ideas that are generated from a dedicated emerging market small cap team. And so these ideas, when you have these global sell-offs because of trade wars or macro-driven factors, typically do okay. The reason is that they're very domestic names. They're driven by domestic drivers rather than global drivers. And the nature of those investments is usually that they're much less levered than the global companies. So that's another inherent risk. And I think an aspect of the portfolio that is quite unique and differentiated across GEM strategies.
Right. Yeah, so I think your truly bottom-up research process, knowing very well the companies that you invest in, and also being able to play around the different sectors that can be more pro-cycle or anti-cycle is the way you hedge your portfolios. I'm going to turn now to Spanish. Podría estar preguntándoles toda la vida cosas porque son personas muy interesantes, pero querría también daros la oportunidad, si alguien tiene alguna pregunta, si queréis podéis preguntar en inglés, si queréis en español y lo traducimos. No sé si tenéis alguna pregunta, si no, sigo preguntando yo. Sí, por favor.
How you see the elections in India going forward, which might give much more volatility? Thanks.
Yeah, no, I know there's been a lot of noise around that, particularly because of the state elections and some of the kind of protest votes that we're seeing there. We're not taking a view that our investments are driven by the outcome of the election. We do feel that Modi's support is much greater than appears. We've seen previous state elections show protest votes and then the incumbent win. So I would still anticipate Modi winning the election in 2019. However, whatever ultimately transpires, I think you're going to have the continuation of orthodox policy with the independence of the central bank that we've seen now play out in quite a difficult period for India, and the continuation of infrastructure spending on ports and roads and railways that has really just sort of started. So in whatever change that comes, I don't anticipate a huge shift in policy, but we're not anticipating that change in spite of the early signs.
Right. Thank you very much. And I think one of the beauties of Franklin Templeton is that we have different investment teams covering similar regions. So now from a fixed income perspective, India is one of your main bets in your portfolios. What will be your view on this question around elections and the economy itself?
I would just say that Basil said it perfectly. So I would say I have very little. No, here I agree completely with Basil, because we also actually, India is one of the few countries which we have a long position in, and it is true that we think that Modi set into place reforms which I doubt very much will be unwound, because how efficiently they have been implemented and the positive impact on the economy is very clear, especially, for example, from my perspective, from a macro perspective, the independent working of the RBI, the way they have managed to control inflation even in difficult times. This gets inflation in India. It's a poor country, it's getting richer, but overall it's a poor country. And inflation, frequently more than growth, is a political question. Inflation is the question, and governments have fallen or risen on inflation or lack of inflation. So I would say this is one of the factors which I think will play towards Modi and his government in the next elections in his favor. But even more importantly, even if the National Congress comes into power, it's unlikely that they would unwind this particular reform, which is an important one. So I would say that despite the elections next year, we do see a positive overall macro development there.
So we are in the fixed income side, and also in the equity side, we're finding good opportunities in that country. ¿Alguna otra pregunta? Sí, por favor.
Sí, buenos días. Yo la hago en español porque mi inglés es un poquito... mercado americano. Cámara de Representantes, demócratas, Partido Demócrata, Senado, Partido Conservador. ¿Cómo Nada, simplemente la pregunta es cómo va a afectar esto en los mercados, ¿no? Vuestra opinión en este sentido, ¿no?
Vale. Y luego tenemos una sesión con nuestro gestor de renta variable americana que también lo cubrirá, pero se lo pregunto. So,
I understood to some extent.
Sana, perfect.
No,
Perfect English, thank you very much.
No, I do speak Italian, so sometimes there is a similarity, but not always. What I would say is that I know that there's been a bit of a relief rally, but I don't see this relief rally, you know, people are putting deep ideas onto this as this is because, you know, Trump is being reined in. I would like to dispel the notion that Trump is being reined in. There is nothing. What is a divided Congress going to do in terms of reining Trump in, first of all? Secondly, I think the relief rally, to the extent that it lasts or to the extent that it is the lack of uncertainty. Markets just don't like not knowing what the political landscape is going to look like. I would like to remind everybody that, you know, the last 6 years of the Obama presidency, you had essentially split government. The president was from a party and he didn't have the whole of Congress. And even beyond that, it's not atypical. You know, different presidents over the decades have lived with Congress, which is divided. Certainly, it is different that there is so much of polarization, so despite that, you know, so there's very little that the two sides can agree on. But again, I would say it didn't start 2 years ago. It really started more like 10 years ago that the divergence between the two parties began. So you don't have very much legislative action. That's okay to some extent because in the first 2 years, while it isn't a very well accepted view, in fact, the legislative agenda which took place over the first 2 years was enormous in terms of the amount of tax reform which got done, the different pieces of legislation which went through. They've had very big impacts. Deregulation will not come from Congress, but it's always come from the administration. I think that continues. Trade policy, again, you have a lot coming from the president, so that will continue in the direction we're probably currently going in. So,
do you see, Basil, David, any impact in your markets? No, not much. No. Okay. Perfect. Creo que nos da tiempo a una última pregunta. No sé si hay algo. Sí.
Voy a preguntar también en español.
Fenomenal.
La política de tipos de la Reserva Federal al alza, eso impactará posiblemente en la política. Estaba diciendo que la política de subida de tipos por parte de la Reserva Federal seguramente llegará a un alza también de la divisa, del dólar, contra el resto de una cesta de divisas mundiales. Y entonces la pregunta es cómo afectará esto a los mercados de renta variable emergentes que ya este año se han visto muy perjudicados por este hecho.
Okay, so I think that the question here is on interest rate will continue to go up in the US. That will mean maybe a strength in the dollar. How they will impact, in particular, emerging market equities.
So I think in the past, what's really impacted emerging market equities has actually been growth. So when we've seen interest rates rise in the US in a strong growth environment, emerging markets have done fine. I think the worry now is that we're seeing a desynchronization of growth with rising rates. Now, what I would say here is two things have changed. First of all, emerging markets are considered much less indebted than developed markets. So actually, the level of government debt, household debt in emerging markets is significantly lower. Even corporate debt, excluding China. So let's put China to one side for now. The other point is that debt today that is in emerging markets in US dollar terms is only 11% of the total debt. And that's come down from 60% during the Asian financial crisis. So when we make these sort of recollections of the Asian financial crisis and the issues that came out of a much stronger dollar and higher rates, I think the world has changed. Emerging markets are better insulated in aggregate. Now, that's not the same for all emerging markets. There are pockets of stress, and they will continue to be under stress. We don't like Turkey. We don't like Turkish corporate sector because it's heavily indebted in US dollars, and not all of that is backed against US dollar revenues. So they will continue to suffer, but markets that have already made the adjustments, that have flexible exchange rates, I think will be just fine. So we will continue to see this divergence, and that's hopefully a great fertile ground for active managers to be able to add value.
Right. So we live in a different environment than in the Asian financial crisis, and it will affect differently from one country to other. Sonal, would you like to add something, because I know that you are also very interested in this dynamic, and there are a lot of countries you said that you are avoiding, like the case of Turkey, but some others that you think there is an opportunity.
So, we do, and it's not that we always agree from an equity perspective and a fixed income perspective. I completely understand that Basel would, for example, not like an Argentina from an equity perspective, because certainly growth in Argentina is coming down. On the other hand, from a fixed income perspective, we actually like Argentina because we have a combination of very good policy making, massive increase in interest rates to attack an inflation problem, and so we actually see opportunity there. And I think that eventually, as the economy recovers, so will Basel, because those good policies will impact the equity market as well. But there are areas where, within the emerging market universe, we see opportunity, be it a Mexico, a Brazil, an Argentina, maybe an India, an Indonesia, but they're few. So I would say that, and all in local currency, clearly, because we are actively taking on that currency risk. I would just say that it's definitely, if based on what we say here today, you decide to jump into emerging markets, I would urge you not to do it via an index, because definitely the interest rate outlook that I'm describing in general will be bad for emerging markets. But if you can find the in particulars where it is going to work, I think you will be very well rewarded. So it just does become super important. Our portfolio as well in this time has become quite concentrated, since there are so few countries we believe are properly set up to manage the period which we see coming ahead.
Right. So generally speaking, that will impact to many countries, but there are some others that won't have that impact. So let me end with another personal question that you love, David. So no, I just wanted to ask you if there is something that you'd like to share with our friends of yourself.
Well, I guess the one thing, because you kind of asked what me before, what is the one thing that most people don't know about you, or something different? I guess the one I would say that I think is relevant to what we're talking about today is that I went back and got a master's in modern warfare in 2010 to 2012.
Now that's disturbing.
Yeah, exactly. See, I told you it would be shocking, and Sonal didn't know this one either. And the reason I did that is because it basically analyzed all the political conflicts and wars from 1945 to present, and really was talking about, and the title Modern Warfare was really that obviously war is the last political move you make when all other political dialogue has broken down. But it really was just talking about how the world is becoming more geopolitical, how we are going to see more and more tension in the world, and actually it was quite good to actually have done that already. So I think it really has served well as we see geopolitical tensions within Europe, but also with outside in the world pick up, to be able to better understand how those are impacted and what some of the long-running themes are, and some of these disagreements have been going on for sometimes hundreds, if not thousands of years, and therefore, how does that impact markets? And so I think that's one of the reasons I really like talking about politics, is I do understand it, and I think at the moment, in Europe especially, Europe is being driven by what the central bank is doing and what politics are doing, and that, and at least in the short term. Longer term, of course, economic fundamentals always override, but in the short term, you can take advantage of that.
It's good to see some people that today still interested in politics. I think here in Spain we're a little bit fed up of politics and politicians.
That too.
So now, what about yourself?
So in sharp contrast with David, what I'd say is it's nothing which helps me at work except to de-stress. I'd say that when I left the IMF, like I said, I had actually accumulated a lot of leave, which they would not cash me out, and I was young enough to need the money. But they did give me the leave. I had 6 months, and I went out and I took an accelerated professional patisserie course at the Cordon Bleu, so all 3 pieces, the basic, intermediate, and superior. And so I often tell Michael, I'm slumming it. I could have been a chef at the Ritz. And so that's what I did. And that's something which still is cooking is a passion of mine and patisserie.
So next time you come to Madrid, you can cook something for us. Basil, what about yourself?
Mine is a lot less sophisticated than both of those.
We're going down to
I'm a die-hard Manchester United fan, and I apologise to all the Real Madrid fans here, but please have some sympathy with what I'm going through these days with the club.
Yesterday you won.
Yes, I know. That's why you see a smile on my face.
Perfect. Thank you very much for being with us today. Muchas gracias a todos ustedes. Espero que les haya dado buenas ideas para este año, para compartir con sus clientes, como decíamos, y por supuesto el equipo de Madrid, Patricia, Ana, Nicolás, Bea o Inés estarán encantados de ayudarles con cualquier otra duda que puedan tener. Inés, ahora viene Patricia, ¿no? Y Brooks. Y damos paso al siguiente panel sobre alternativos con Patricia Molpeceres y Brooks Ritchie. Muchas gracias.